Let's start, guys. So I see that most of you guys already have some background, right? A year and a half, 2 years, and so on. So that's great. So it will be much easier to progress and move forward as we go along with this presentation. And like Alex mentioned, you can definitely leave comments in the chat, and we will answer some questions, and we will answer them at the end of the presentation. So what we're going to talk about is building a portfolio in 2025, which is totally different than what we learned or heard about from our parents or grandparents on how to actually build a portfolio and what is a portfolio, right? And let's dive in. So first thing we need to know, and by the way, this presentation, I got to share with you guys, I built it through an AI. It's called Gamma. I'm not an affiliate of them or something like that, but they're really great. I tried it. I loved it. We're going to answer some of the questions like why build a portfolio? Eventually, I mean, we need to think why, all of us are traders. So in most cases, we only see the next big trade that we want to do. But when it comes to thinking a few steps ahead, we got to understand that a portfolio is needed. We're going to answer the question, what is a portfolio, a healthy portfolio that actually has a few diversification basically within it and multi-structure and is a bit more complex, but in a good way, compared to, like I said, what we learned from our parents, for example. And at the end, you cannot really talk about portfolio without talking about a drawdown. So we will leave a few minutes talking about drawdown in generally about the portfolio, but also about how to get yourself out of a drawdown from a trader perspective as well. So let's continue. All righty. So what's a portfolio and why we actually need it? So obviously, up until today, we know that we have a traditional portfolio, where basically is a portfolio of a buy and hold, and we'll talk about it in a second. But it makes sense that every one of us, and it doesn't matter if you're in your 20s, 30 or 40, gotta have something for the long term as well, mid-term, long term as well. Because we all know this, we probably saw it on YouTube or post on Instagram, what would have happened if I took $1,000 and put it in Google when it first started, or the Bitcoin when it first started, and so on. And this is something obviously that we want to aim for as well, because maybe we won't find the next Google, but we can first search for it. And second, even though it won't be Google, it could be others that will give us a great return after 10 and 20 years of holding. And basically, what we're trying to do is creating wealth, besides the fact that we're trading, and trading is mostly for the, as we call it, like the income or the paycheck, right? Comparing to investing when we actually want to build wealth. Second thing is the passive income. We can use actually investing for getting money, free money, right, from dividends. So I'm talking about obviously stocks, but when you're buying, for example, McDonald's or Google or Apple, they all share dividends with the shareholders. And once you do that, once you hold your stock for X amount of time, you will get that into your bank or into your broker account. And this is basically a free money that you get, right? And it doesn't matter if the stock is going up or down, if you're losing money or making money, like unrealized money on your portfolio. At the end of the day, if they share dividends, you get it, as simply as that. And this is something that you can definitely use in order to put back into your investing. So you get some dividends, you put it back into your investment, and you continue to grow your account. And the last thing, and I'm not quite sure that it's applied for all countries, but I'm guessing that in most Western countries at least, you can get a loan when it comes to on top of your portfolio. So for example, if I have $100,000 of account, I can ask the bank to give me on top of that, to give me, or because of that, to give me like 80 up to 80% in most cases. Obviously, check it with whenever with your bank and your country, but in most cases you can do that, and then you can take this $80,000 that you get as loan and either put it into investing or use it for real estate, for example, or whatever it is, to basically leverage yourself. Because a lot of the times when it comes to building wealth, it's actually the focus should be on leveraging yourself, obviously with a good amount of risk management. But if you look at the top-notch investors and the guys that in the top list of the like the 100 richest people in the world, they are all leveraged their money, right? They're not just using their own capital, but they're actually using the bank or other people money, like you do in funding, for example. So that's also something that you need to consider. If your country allows that, this is definitely a great way to leverage yourself and push it beyond what you have actually. Alrighty, so two types of portfolio. The one that we just talked about, the traditional one, you buy and hold. There is nothing to do with it. You took IBM, for example, a common stock. You just buy it and wait 10, 20 years until you're retired. Your retirement comes and then you sell it basically, right? This is one option. And the other option will be the 2025, which is much more flexible, which is active. You manage the trades, you manage the portfolio, the diversification, and obviously, if you do all of that, it should be also healthier and wealthier. So in that case, you can still definitely do the traditional when you just buy stocks and hold them for a long time. But because, first of all, we have the knowledge, and we'll talk about the edge, what we bring to the table. Because we are traders, we have those nuances where we can actually be more active and manage the portfolio and actually make more money comparing to just buy and hold and wait 20 years. So in that case, we're still aiming for the long term, and we'll talk about the time frames, but we're still aiming for the long term. But we are trying to get much more out of that capital instead of just buying an all the common stock. And I hope it makes sense, because today with the tools that we have, for example, from AIs, and again the knowledge that we have as being a trader, we can definitely take that to advantage and actually shift a little bit and change it as we go along, comparing to just buying and hold. So we have more knowledge than the common people, the public, that in most cases won't be too much involved or won't be involved in his portfolio or her portfolio. Alrighty. Next slide. Again, I'm still testing this this gamma thing. So next slide is not coming. Let me try to do that. Let's see. Okay, got it. Alrighty, so when it comes to building a portfolio, and we're doing it right now together, so try to think what we want to have in our portfolio. We are building it right now, right? The 2025 portfolio. What do you think? And let me know in the chat. What do you think should be within our portfolio? And we are aiming for a few time frames, different time frames, but let's say the longest time frame will be like 20, 30 years. What do you think will be inside of that portfolio? While you're doing that and writing, there are three elements that we want to take into consideration. One, obviously, the risk. We all aware of that. This is something that we encounter every single day when we click the mouse key, right? And the risk is basically what we are willing to lose on that specific portfolio. Later on, we will talk about the unrealized loss and the realized loss, which are two different species, basically. But this is something that we need to decide, the risk side. We need to decide before actually clicking the mouse key, before actually making that investment. Second thing is the time frame. The time frame that we want to aim for, like I said, in a traditional way, it will be a long term, like 20, 30 years of holding. But we actually can combine the three elements, which is short-term trading, mid-term, that could be for a few months or even a year, and long-term, 10, 15, 20 years. So we can mix everything together instead of just holding one position for a very long time. And the last thing is, how do we split the pie, right? We have the weight that we want to split between all the assets or all the markets we are having within that portfolio. And we need to decide how we actually going to do that. So I want to go through the chat to see if you're with me on that. Let me know, guys. Okay, I see that you're writing stocks, bonds, gold, crypto. Alrighty. A few stocks, Nasdaq, S&P, crypto. Okay. Alrighty. So this is definitely something that we wanna cover, the stuff that you mentioned here. And let's go to that slide and see how we basically going to split this pie, right? So when you think of a portfolio and you sit at home and build yourself the right portfolio, in most cases, stocks will be at the top of the list, right? Probably 50%. This is what I put here, 50%. We'll dive in a second. We'll dive into the stocks sector or market, and then break it down to a few types of assets within the stock market that you can put in your portfolio. But this is definitely something you want to hold for a long time and have enough weight on your portfolio, because we do know that the markets, at least for now, if you take 100 years back, the markets actually made it up and actually reached all-time high, right? Maybe beside the Australian, if I'm not sure about that, but at least the US market definitely did a few times after those drops. Besides that, I'm also adding here the cryptocurrency that you can definitely add to your portfolio. Obviously, this is, again, a long-term investing in this case, or a mid-term, but obviously much more volatile and more risky, since it's fairly new. And we didn't see a whole lot of recessions or crises to see how it will react eventually. And obviously there are many stuff of regulation around the world around it. So in that case, this is something you want to add to your portfolio, but not necessarily more than 10% from the total. I did put some Forex here, mostly for hedging, not to see some huge jump from it, of course. Commodities like oil, like gold, wheat, palladium, platinum, a lot of commodities that could be definitely interesting for a long-term, mid-long-term. And one thing that is something fairly new to the world of portfolio, which is the funded accounts, right? Because when you think about it, first of all, when you get funded, in most cases, you can buy and hold, you can actually hold your position for a long term, right? You don't have to sell it. It's not just day trading. You can actually hold your position when you fund it. There isn't any reason for you to cover if it's something that you're looking for the long term. Second thing, you'll leverage yourself, right? As I mentioned before, the loans that you can take from your banks, if you have a portfolio account, then you're basically doing exactly the same thing here. You use the funded account, you use our capital in this case, in order to leverage your profit. So this is something that I would actually put a lot of focus in my portfolio, and not just the classic one as I mentioned before, because now that you have that ability, that option, you can definitely use that to your advantage. And so I put 20% of funded accounts. Obviously, it doesn't have to be just one funded. It could be a variety of funded accounts. Some of them could be for Forex, some of them could be for stocks, some for commodities. You can play with it and build a portfolio, a funded portfolio account. So this is something to definitely consider here. And so looking at everything, at least from a financial market perspective, these are the assets or the markets I would go with. You can definitely add another chunk maybe for real estate investing as well. And also some new age investing, like investing in startups and other stuff like that. Alex, I don't know if you did that or you did that with us, but we actually invested in a vegan chocolate company this other, like I think last year or so. It's a startup, something that moving forward could be a potential nice gain with it. So this is also something you can add to your portfolios. But when looking at least the asset that you usually trade, this is what I would build from the markets. So going into the 50%, right? The stock plays or the stock market that you want to hold your portfolio with. I broke it down to four different aspects, right? You have the individual stocks, which is higher reward or higher risk, higher reward. Sector ETFs, broad market ETFs, where you can actually expose yourself differently in order to lower your risk in that case. And of course, index funds that you can hold for a long time, as said. But there is also something that we can do that most public, most guys that hold in portfolio in the public won't do, and also in the banks, they won't do that, in investing banks and all. They don't do DCA, right? And we can definitely do that as traders. And DCA, for those of you who are not familiar, the terms is dollar average cost, right? The dollar cost average. It's basically meaning adding to your position as it goes either to your favor or against you, right? For those of you who saw me trading in the Fiverr's live trading room or other webinars that I did on the Fiverr's YouTube channel, where I shared my scaled account on the hyper growth plan, you can see the trades that I did there, and I also explained how I'm doing that. Maybe if we will have a little bit more time, we will touch on that as well. But you can definitely build your portfolio according to DCA and not necessarily just buying and holding, right? So DCA meaning that I'm buying, let's take the Nasdaq, right? Or the QQQ, the ETF that represent the Nasdaq 100. And every month, on the first of the month, right, I'm buying the same amount of money every single month. So let's say I'm buying with $1,000 on the first of every month, I'm buying the Nasdaq, right? All the time. So I'm compounding, right? I'm building that portfolio by compounding and by averaging my position. So if I'm doing that, if it goes to my favor, great, I'm adding more. If it goes negative, and we'll see a chart in a second, if it goes against me, I'm adding more to the position, same price, same amount of money, right, on the same day. So a lot of the guys that doing DCA, and maybe you saw a video on that, they will do what I just mentioned, regardless of what the chart is doing, because we're looking for a long term, like 20 years. So they would say that in most cases, it doesn't really matter what the chart looks like, but they will add the same amount of money. And for the long term, it will be right for them, because the market, at least the last 100 years, continued to rally. Doesn't matter if there was an advantage. It's an advantage if the market is dropping, because you actually can add more in a lower price. So DCA is definitely one to consider. we will learn, we will talk about it in a second, and learn how to DCA plus it. So we can actually use the DCA concept by, but finding the right areas to add to the position a bit differently than what is a classic DCA. So again, going into the stock area, when we break it down, the stock market, when we break it down and want to understand what to add to our portfolio, this is definitely could be the right split. When, of course, individual stocks, because it's higher risk, we don't want to have, from that 50% that we just mentioned, we don't want to have 40% out of it, right? We want to have 10, 15% out of the 50, which is individual stocks. Now, we can play with it even more. And, you have classic stocks like Google, Apple, Amazon. Obviously, we want to hold those. But we also can find those unique opportunities, because the market is full of those crazy companies, startup companies, just IPOs, went to the market. And now if you take back, let's say, NIO, the electronic car, at 2020, right? It went from $5 to $70-something within a month or so. So those kind of stocks you can definitely watch for and look for and want to add to your portfolio, but it doesn't have to mean that you will hold it now for 15 years or 20 years. So you can mix the two, right? You can have those Googles where it will go for a long term, and you can have those short term, mid-term, where you're actually looking for that pop, right? The one that just got out, no one or most public don't know about it, but once the public will know, they will jump on it, and it will push 100 or 200 or 300% up, and then you can sell it. So it's within your portfolio, and if you believe that in 20 years it will be relevant, you can leave a tiny chunk in it still, but take most of it out. So this is for the individual stocks, right? It could be those big names, or it could be potential movers. Sectors ETF and the broad market ETFs, obviously you can hold all the XL something, XLF, XLQ, XLV, XLU, those all ETFs that covers different sectors in the US market. And that's great. And you can also try to go not just for US stocks, right? If you want to find a little bit more edging, or find the next big market, that could definitely be emerging markets as well, right? So you have your US market portfolio, but you also add in some ETFs that covers the European market, the Asian market, maybe South American market like Brazil. That's a huge market there as well. So you can definitely mix a few of them. So out of this 50% that we mentioned that you hold in stocks, within that you can dive in and play with it as well. And one more benefit that we mentioned before is the flexibility that we as traders have comparing to a bank, which if we see a strong move to the upside, we can definitely take a chunk out, put it in our pocket, and then let it continue, again, differently than what the bank will do, which holding it for a long time. All righty, next slide. Next slide. We'll do that. Okay, so this is our edge, right? We have the trading knowledge, so we can analyze the chart, and actually when we DCA in, we can actually understand where we want to add more to the position. If I just said that every month you buying the same amount of money on the same day, you buying the market, right? You DCA and you average in your position. So instead of just doing that, you can tweak it just a little bit more and actually say, you know what, I know that today it's the first day of the month and I need to buy with $1,000, but I see that if the market will drop just a little bit more, there is a major liquidity level that in most cases it will bounce from this one, right? So then I say to myself, okay, I will wait a few more days to see if the price will drop to that major liquidity level, and then I will add more. Now, if that liquidity area is a very strong one that we didn't touch after like few months or even few years, this is a place that maybe I don't want to add just $1,000. I want to add $5,000, right? Because I'm averaging, the DCA is averaging my position. So if my position, my holding position is here, like the average price is here, and the market dropped, and now it's reaching a very crazy level, I can add more here, and then I'm dropping the average price lower, right? Comparing to DCA, in a classic DCA where you add always $1,000, $1,000, $1,000 every single month, right? So you can use your trading knowledge in order to analyze the chart and understand where to add more to where to add to your position and where to add more. So you don't have to be just a systematic or robot, but you can actually manage it according to what you see on the chart. And that in most cases, if you do that right, obviously, in most cases, it will give you a huge advantage on others that will, just buy every single month. You can use today AIs to build your portfolio, right? You just click of a button and you get tons of information about each company. I did one research very lately with one of the AIs tool. And basically, I told him this. I'm looking for the next Google, right? This is what I wrote to him. I'm looking for the next Google or Amazon. I want 5 different stocks that you think will be the next Google or Amazon, considering 20 years, the way you see the market and the way you see the world in 20 years. And I added one more thing that is super important, which is look for stocks. In that case, I looked for stocks. Yeah, look for stocks that the management of the company already proved themselves at least once, right? So the CFO or the CMO, the marketing guy or the finance guy, and the CEO, at least one of those 3 actually showed proven method over the years before that. Once I did that, because obviously I worked with him a few times until I tweaked it, but once I did that, I actually got much better results, at least look like on paper, because now I have guys that actually prove themselves. Because you can have a great idea, take the funding idea, right? Take the literally like the prop firm idea, an incredible idea, but you have companies that already have proven guys that they know what they're doing, right? Like in our case, like in the Fivers, Gil Ben-Hur and Saul, of course, and Tomer, our CMO. So those guys already proved themselves and they actually know what they're doing. So you can, on the next project or the next company, let's say if Gil Ben-Hur, the founder, will build the next company, you already know that he's coming with track record, right? So that's the same concept right here. I'm looking for a company, not just an idea, but also the guys that can drive the team, that can drive this company to become the next big thing. And that was, once I added that to the AI, that was the game changer. Up until that time, I got plenty stuff that he gave me, but nothing that actually catched my eyes, really. Once I added that, it was the right one for me. So, for example, ACHR, I'll put it here, ACHR. So that is, HCHR is basically a company that building vehicles, flying vehicles, right? For urban, for the cities. And that will be, landing and takeoff and landing from the road within the city, right? So if you all saw the Fifth Element, it's a It's an old movie now, I think 2000 or 2005 or so. But back then it was crazy to see those flying taxis. So this is probably something that we will have in the next 20 years or so, or maybe 30. So this is one that he gave me. And the guys that actually operate in this have a great track record, a proven track record. So this is something that I at least consider. One more thing, so you can easily do the AI thing, research, shorten the time that you need to do it, but try to be creative. Try to add stuff that are not the common knowledge, right? Not something that everyone will ask. And last thing, like as I mentioned before, the adaptation, which is shifting, tweaking the strategy, the type of company. Like I mentioned, NIO, for example, the electric vehicle, and there are tons of examples like NIO. You know, a stock that is traded at around $5, popping up and doing popping up from 5 to 70 or 200, and that's it. You need to get out of it, so you don't have to wait 20 years until you see something from it. You can always leave a chunk in it, but generally speaking, you just took your profit and you're out. So adaptation is something that we have compared to big institutionals that don't have that ability. Alrighty, moving forward. I'm dying to see the questions, but I'll move forward and then we'll stop and talk. Yeah, I don't hear you, Alex. Don't hear you.
I said there's loads of questions. You're just in the swing, you know. You're flowing. Yeah. So cool. I'm gonna let you go through it, and then we'll go after the questions, because there's loads of different things people are talking about, from how the prop firm industry works to accounts to absolutely everything. Okay. So
we'll touch base. Yeah, we'll touch it. All righty. So the knowledge that we just mentioned, clear levels, defining a specific DCA, making it better, find new opportunities. Like I said, locate the next Google, and also cash for crash. And this is also something like a technique or something that you need to remember to do. Put money aside, because the next time we will have a crash, and this is obviously, there is no doubt we will have a crash the next time, right? It's just a matter of the time. So the next time the market will collapse 20%, 30%, 40%, we're already getting closer to that. The Nasdaq dropped 15% the last month. So the next time we will have it, you need to have enough cash on the side in order to put a big chunk of it inside, right? Imagine DCA in, and then in 2008, when we had the subprime crash, at the bottom you add in a bigger chunk. Or 2020, the market dropped because of the COVID, adding more to the position. 2022, or even as we're getting closer right now with the Nasdaq. So always have some cash on the side, just because when the crash will come, you will have the opportunity to do so. Obviously, if you go to the real estate market in 2008, the subprime crime in the US, you have tons of opportunities in the real estate market, right? So that's the same concept. If you had cash aside, you could have done very nicely. Alrighty, so we're reaching that last mile, and like I said, you know, we can talk about portfolio and looking at the potential, but we got to look for the risk as well. And there isn't, I mean, you cannot have a portfolio without having a drawdown, right? It's like trading, but also for the long term, when it comes to portfolio, you will always have those drawdowns. Exactly like now, right? A lot of the guys, and I've been chatting with my friends on WhatsApp and whatnot, and obviously all of them are in the market, and every single day when the Nasdaq is dropping 2% more or 3%, they sending me a text and saying, I'm losing so much money, what should I do, and stuff like that. So obviously there will be times when you will find yourself minus 30, 40. In the subprime, you could easily find yourself 50% down. So the thing about it is just understand, first of all, your tolerance, right? And when it comes to long term, at least, like I said, at least in the last 100 years, we saw that the market actually shifting back up and breaking to new highs. So we can expect that to continue until the whole financial markets will collapse totally and we will change it to something else. But until that will happen, it makes sense that the market will continue to rally after those crashes. Maybe it will take it not just a few months to recover. The Japanese market, it took it something like 30 years or so until it reached the new high. But eventually, if you hold in your position for a long time, you will see a recovery, right? So this is something to remember when it comes to our portfolio for the long term. And also, obviously, for trading. So we need to separate those two, portfolio and trading. When it comes to trading, your trading portfolio, you should in that case have some limitations, right? Because eventually, maybe you enter the market and it dropped down, you lost all your account, and then it will recover after a few months or even years. So in that case, on your trading account, you definitely need to have some limitations. But we also need to remember, and that's probably the most important thing, to remember the mental side of it, right? Because on a portfolio level, your unrealized loss doesn't really matter. And of course, it's hard. And I'm sure you guys are all aware of that. And maybe your parents talked to you about it the last few days, or your friends. Everyone is looking at the market. It's in the news. Everyone knows that the Nasdaq is dropping. Tesla dropped like 50% in the last 2 weeks or 3 weeks, right? Nvidia 20%, Google 20%, 25%. So everyone is talking about it. But unless you realize the loss, unless you cover the position, it's just on paper. Now, of course, it's not fun to see that on paper, but it's still something that you need to remember, that you're aiming for the long term. So it doesn't really matter right now that you're in a loss. The only thing that matters is, where do I DCA, right? Where do I add more to the position in order to drop my average? Because we are aiming for a long term. Obviously, when it comes to trading, you need to act differently. And I'll talk about a loss that I have in a second. So remember that there is the realized and the unrealized. When you realize the loss, that's a whole different story, because your mentality now is not just, I'm losing money, but maybe it will return. Now, when you realize the loss, it's actually, that's it, I lost it. Now I need to work my way out of it and basically recover from that loss, right? Two different things when it comes to like on the mental side of trading. As long as it's a portfolio for long term, your unrealized won't matter, right? In profit or loss. It's a long term. It doesn't really matter. So remember that, because a lot of the public doing the wrong thing when they actually seen the 30% drop, 40% drop in the COVID, it happened like crazy. It dropped very rapidly, and then everyone just sold their accounts, sold their position, right? Covered their position, instead of just waiting until it recover, or better yet, look for the place to add more to the position, right? Two different ways to look at it. In 2008, when you're watching the news in the subprime, you're watching the news, and on the news they all tell you to sell to close your position, because the market is about to crash even more than what it already did. Then in most cases you will go and realize the loss. But this is, and we're going into a manipulation and all of that. This is actually a smart money play, when they actually telling you what they want you to do in order for them to buy in a cheap price. So you sell into them. I'll continue just a bit here. Okay. So this is exactly what we just talked about, the Nasdaq Daily. Actually, I changed that. This is, I had a different chart here. So it's actually 2025. This is the drops from the last 2.5 days, 2 weeks. And most cases when people seeing that drop, they're actually closing their positions instead of just finding the next place to add to the position. And this is crucial because every time we saw a crash, 2020, 2008, 2000, the dot-com bubble, 87, 29, the market recovered at the end of the day. So we just need to hold a little bit longer and find spots where we can average our position to a better position, basically. Yeah. But when it comes to talking about trading, I had to bring that, Alex. And I'm not sure, probably some of you guys at home already heard me talking about it because Alex and I did a few podcasts about it, and also I did a webinar. What's that?
So this was a big, an extraordinary trade. We've been talking about this quite a lot, haven't we?
Yeah, and I guess when talking about a drawdown, I gotta talk about this one as well. This is a trade that I made, not a portfolio. So a trade that I made and I lost almost 100K in 3 days, and I wanted to touch. Do we have a few more minutes, Alex? Because this is the juicy part.
If it's juicy, and if it's juicy, I know it's juicy, so go for it. Yeah, go for it.
So we had those 3 days, right? This is it, only 3 days, and I'm losing and getting my ass kicked by this SPCE company, Virgin Galactic, that trying to fly, at least back then, try to fly people to the moon or such, to space. At the end of the day, I saw that the stock is now traded at around $3 or so. So I'm super happy it collapsed even more. But to make a long story short, that was a place where I realized the loss, right? I closed the position eventually, and I needed to recover from that drawdown. So how do I recover from a major drawdown, right? The first thing you need to do, and I see Rich on the line, so we will probably could add a lot of mental and psychology aspect for it on top of it. When you try to recover from a loss, like a big loss like this, you have few things that you need to do, right? One is on a technical level, which is fairly easy. You go back to the trade, you analyze it, you see where did you add to your position, how did you scale in, scale out, your risk side, everything involved of the technical and what you could have done better, right? That's fairly easy because you understand that level. The second thing is how you take yourself out of that loss on the mental side, right? Because you had, this is probably 5 months, 4 months, 5 months of work that I lost in 3 days. And how do I take myself out of that? And this is realized, right? I don't have it anymore. Now I need to understand how do I not just get back to the game and prove myself that I can do that, but also, making that money, return that money to my pocket. So there are a few mental aspects to it. And there is one thing that really helped on that, or two. One is once I went back and saw the other things that I performed, like other trades that I took before that, I saw that I know what I'm doing, right? So it was easy for me to learn and see, actually prove it that I know what I'm doing, that was just a step back and not something that I usually do. So once I proved myself that I know what I'm doing, it was easy for my mind to say, you know what, that was a step back, but now you can continue to do what you know, what you already proved to yourself. This is one thing. Second thing is just, again, on the mental side, I actually separated it from thinking of that money that I lost, and actually said to myself, okay, now my account, if I'm not mistaken, it was like a $300,000 account, and I lost almost 100, so it was roughly 200. Now my account is at $200,000. That's it. That's the number. I didn't have 300. I don't remember it, like separating it, eliminating, removing. I only have 200. Now I'm trading. Once I did that, and obviously it takes time, and you need to really focus on believing of what you're saying. So once I did that, it was easier for me to operate on the technical level, because I didn't have that. I got to get back that $100,000 loss before I continue to, let myself loose and continue to trade properly. So once I told myself, this is what I got, $200,000. That's it. I didn't have 300 before. I only got 200. So when I did that, it was easier for me to approach it mentally and actually recover from that. And of course, bunch of other stuff involved in it. Try to think always, and this is something that I'm talking about a lot, and try to do that as well. Always compare yourself to how big names like LeBron James, Messi, whatever, what they do when they have a streak of losses, right? You go into the court, you play a game, your team lost, another one. What do you do in order to put yourself out of that? And once you understand on the mentality level and on the technical level how to shift that and push yourself back up, it will be much easier to do so. And I will take just one more minute, Alex, if I can.
Gosh,
yeah, no, I can't.
No, you can. We've got a little bit of time. I know we've got about 7 minutes. There are quite a few questions.
Okay.
But go on, I'll let you do that, and then we'll some questions.
Okay, I just wanted to talk about this one. That's my hypergrowth account on the Fivers, of course. That's the last one. I'm missing like 4K in order to reach the 640. So that's so I'm happy about it. Once I will do that, I will probably do another video and talk about this huge move in the price that I don't like, that I didn't like to, although it's a great trade that I made here, but it wasn't the right one for me, and we'll talk about this. But I wanted actually to just cover this one, the drawdown that I have, right? Because a lot of the times when you start your evaluation or start your funded account, you will have a drawdown at first instead of going right back up, or start with a move up. So in this case, when I started at 320, I went down to 314, right? And then I started to find again the rhythm that pushed myself up. And the reason I got into that drawdown was mostly lack of focus. But the way that I got myself out of that was getting into the zone again. So I went back, checked what I didn't do well on the technical and the mental aspect of it. So on the technical, I was very much more aggressive than usual. I tried to click the mouse key on everything that I see and not waited until I saw that A+ setup. Added more to the position very quickly, although the market was very volatile, so I needed to wait instead of that. So those kind of things that I did. And once I understood that, it was easy for me to say, you know what, let's start from the beginning. I'm not trading 320,000. I'm actually at 314. Now let's start to trade. So I waited for that right setup. I added a little bit more cautiously, waited for the places exactly how to DCA basically the trade. And then I found my rhythm back, and hopefully I will reach that this week or maybe next week or so.
Couple of questions, because these are super important questions, and I've had a big loss as well, and I've also been in a trade where I'm physically frozen. Like I can't close it, and that's due to probably a lot of over leveraging. But you were in the same situation. I remember we talked about this a few years ago, where you were going to teach some other people, do some basic stuff with people on trading, and you knew in the back of your mind your P&L was swinging, like $10,000. It was like, I can't remember, like 90 grand down. How did you close that position? Like, honestly, because it takes a lot to first, when you're down that much, to close the position is super, super, super difficult. And I know there's people as well there that have probably found themselves in a position where they physically, it feels impossible.
Click the mouse key, huh?
Yeah, it's super hard to do it. So how is that? How did you do it, and how maybe can we prevent that from happening?
Yeah. First of all, regarding that loss, when I had it, the last day I started on Monday, and then Wednesday I closed the trade. I traded in my friend's office. He has a big real estate office, and I went there to trade that day. And he just told me, get yourself out of that trade. He actually said it to me, So it was something from the side that actually helped me to do so. But besides that, I said to myself, okay, I lost already roughly 4 months of trading, right? And I said, okay, I can continue to trade, continue to hold the position, but what if it goes against me? I said, I just try to, visualize what will happen tomorrow. It will continue to go against me. Am I willing to lose another 20 grand, 20 something thousand on that day? What will happen if it will continue to go a little bit more than that the next day, right? So I said to myself, that's a shitty situation where I'm at right now. But if I'm not closing it, I can, lose the account, right? Or get myself to a point where it will shift completely my mind in that case. So that's the trick that I used, at least.
Some of the best advice I think you ever gave me with trading was, you said to me, trade what you've got now, not what you had. And I think a lot of people as well do this. If they lose or they make money, whatever it is, they're always trading what they had if they've lost it. And that revenge trading, trying to get it back, can put you into a deeper hole. So that was some really big advice that you gave me. But this is something I think a lot of people understand. With DCA, it can be like a double-edged sword, and I think maybe people may get it confused as DCA is the same as averaging into a position. Maybe we can talk about maybe the difference of averaging into a position to DCAing on a.
Yeah, sure. So the concept, like I said before, the DCA is just buying every month the same amount of money every month and just building that position, right? So it doesn't matter, like on a classic level, it doesn't matter what the market is doing. You're just buying once a month. You just add into your portfolio, you're compounding, and eventually you're playing with the average. But eventually, if the price will continue to rally, then you'll do good. Comparing to trading, and there's a lot of like what it's called martingale, for example, right?
Yep.
So a lot of the times we confuse that when it comes to trading, when we actually add in double or triple to the position, and in those cases, in most cases you will lose your account, right? If you add into your position by doubling it or tripling it, it won't last long. You need to do two things. One, add to your position, but as long as it's within the full risk that you're willing to take, right? If I'm willing to lose $100, then I will add to the position. But once I'm reaching that $100, I'm out. It doesn't matter if I need to add more. No matter what the market is doing, I'm out. So it's got to be a dollar limit that you're willing to take on that trade. As long as you didn't reach it, add to your position like crazy. But once you reach it, you're done. Now, if you want to do it obviously smarter, then you need to find those liquidity levels that you say to yourself, okay, I entered here. I know there is a major level here. Only when the market will drop to this level, I will add more to the position. Again, within the risk that I'm willing to take. And that's literally on a technical, like on the risk management side, at least in my eyes, of course, that is by far the number one key to succeed in the market. Add into the position while you're within that risk. Most traders will add more and more and more, crossing that limit that they were supposed to lose, and just get a better average price. But obviously, like you said, this is a double-edged sword.
Okay, one last thing, because you've taken up all the time, Michael.
Sorry.
Can't stop you from talking. We're going to bring Rich on straight away because we're behind schedule now by 2 minutes. But give everybody here just some of that little bit of advice, like you've done to me in the past, like you're sitting as a trader over the shoulder. Give them that bit of advice so they can take home that will actually help them with their trading in their own journey. Okay,
so first thing, as we talked about, build your portfolio, right? You got to build your portfolio for the long term. 20 years from now, if you're in your 20s, 30s, 40s, Alex is like my son, and I'm always trying to just tell him, build that for the long term. Seriously, guys, this is something that you need to do. Start small if you don't have a whole lot, and use the funded accounts to do that as well. Leverage yourself, leverage the capital that we give you to do that. 100% go with that. Second thing, I'm going back to the same thing that I mentioned. Average your position, stay within the risk boundaries. You will do great.
Amazing. Well, thank you very much, Michael.